There are over 35 completely legal ways to extract cash from your limited company, which will slash your tax bill. By knowing these, you could take your tax rate from 40% to 12% or even lower. So let's get into it. We're going to start with the fundamentals and then we're going to move into some seriously powerful advanced strategies that most business owners have never heard about. So strategy one, the smart salary dividend mix. First up, getting your salary and dividend split right with the new national insurance changes. This is more crucial than ever. If you're a single director company, you'll want to keep your salary at £5,000 to avoid any brutal 15% employer's national insurance. Then take the rest as a dividend up to £50,000 to stay within the basic rate band. But here's the kicker. If you employ anyone else, even your spouse, you can claim the employment allowance. And that wipes out up to £10,500 of employer's national insurance. Suddenly, you're paying yourself your full personal allowance at £12,570, and a salary makes sense again. And this simple strategy alone can save you up to £2,000 in corporation tax while keeping your personal tax bill to a minimum. Strategy two, pension contributions. And this is where things get serious. Your company can contribute up to £60,000 into your pension, and every penny is tax deductible. So if your company made £100,000 profit, you can put £40,000 into your pension and you only pay corporation tax on the 60,000. At 25% corporation tax, that's a 10,000 tax saving right there. Plus your pension grows tax-free. And while pensions are never sexy, it's one of the most powerful wealth building tools available. Strategy three, director's loan account. You can borrow up to £10,000 from your company completely tax-free as long as you repay it within 9 months of the year end. And that's perfect for funding that family holiday or home improvements without triggering a tax bill. Just don't mess this up, because if you miss the deadline, HMRC hits you with 33.75% tax charge, and that's worse than basically any credit card out there. Strategy four, income splitting with your spouse. If your partner isn't earning much, transfer some shares to them. They have their own personal allowance at £12,570 plus £500 dividend allowance. So that's over £13,000 of tax-free income you could be missing out on. You'll need proper share transfer documents through company's house, but this could easily save you thousands in dividend tax each year. Just don't get divorced. Strategy five, the mileage allowance. And you can claim 45p per mile for the first 10,000 business miles in a tax year. Then 25p after that, and that's completely tax-free. Say you do 8,000 business miles annually, that's £3,600 straight into your pocket with no tax consequences. So client visits, business errands, even trips to the bank or account all count. Just not your regular commute to a fixed office. So keep a proper mileage log. We've got a mileage log template in the notes below, and this strategy could be worth thousands of pounds for you. Strategy six, employment of family members. Employ your spouse or your children for legitimate work, pay them within their personal allowance, and it's tax-free for them while being fully deductible for your company. Your spouse could handle admin, bookkeeping, social media, and your kids could be helping with the packing, data entry. Just make sure they're doing real work at market rates. HMRC isn't stupid. They'll challenge 150k salaries for filing a few invoices. But done properly, this spreads income across the family and maximizes everyone's tax-free allowance. Strategy seven, mobile phone provision. Your company can provide you with a mobile contract, the whole package, not just reimbursing your personal bill. HMRC doesn't care how much you use it personally. There's no tax, no national insurance. If you're paying £50 a month personally, that's £600 a year you could be saving by switching to a company contract. Strategy eight, annual functions. Spend up to £150 per head per year on company events, and it's completely tax deductible for your company, and it's tax-free for attendees. So things like Christmas parties, team buildings, summer barbecues, they all count. Even as a sole director, you qualify. That's a £150 Michelin-starred meal courtesy of your company. Just don't go over by even a penny, because if you hit 151, the whole amount becomes taxable. Strategy 9, trivial benefits. Your company can buy you gifts worth up to £50 each with a £300 annual limit for the directors. So birthday presents, Amazon vouchers, bottle of wine, all tax-free as long as they're not cash and not linked to work performance. Strategy 10, a cycle to work scheme. Buy a bike and safety equipment through your company via salary sacrifice, and you can save up to 42% on the total cost. So £1,000 bike might only cost you £580 after tax and national insurance savings. After 12 months, you can typically buy that bike back from the company for around 5 to 10% of its actual value. And it's perfect if you want that carbon fiber road bike or electric commuter. Strategy 11, childcare support. If you have kids, this is huge. With tax-free childcare, for every £8 you pay in, the government adds £2 up to £2,000 per child annually. But here's the catch. If either parent earns over 100k in adjusted net income, you lose the eligibility. So careful planning around your extraction timing is crucial. Strategy 12, home work allowance. The boring £6 per week allowance everyone knows about, but it adds up to £312 annually, no receipts required. Strategy 13, professional subscriptions and training. Your company can pay for professional memberships and training courses, CIPD, Law Society, Chartered Institute of Marketing, all tax deductible for the company and no personal tax for you. Training courses count too, as long as they relate to your current role, and that's thousands in personal development paid for tax efficiently. Strategy 14, company life insurance. Set up a relevant life policy where your company pays the premiums, no personal tax or NI for you, full tax deductions for the company, and your beneficiaries get a tax-free lump sum if the worst happens. A £1 million policy might cost £60 annually, and it's peanuts for that level of protection. Strategy 15, late night transport. If you work past 9 p.m. and public transport is stopped, your company can pay for taxis home, and you can do this for 60 journeys a year. Each trip is tax-free as long as it meets that criteria. So now we're getting serious, and these strategies can extract significant sums with minimal tax consequences. So strategy 16, home office rent. Instead of that measly £6 weekly allowance, you can charge a percentage of your actual bills like mortgage interest, rent, or utilities. And this can be as much as £3,000 to £5,000 annually. The company gets a tax reduction and you can withdraw that money. Strategy 17, charge an interest to your company. If you've lent money to start your company, charge commercial interest rates. Currently, they're at 3 to 8%. The company gets a tax deduction, and as a basic rate taxpayer, you get £1,000 off interest tax-free annually. There's quarterly reported to HMRC, but it's another efficient extraction method. Now, strategy 18, equipment. Own equipment personally that your business uses, cameras, tools, maybe office furniture, sell them to your company at a commercial rate, and then you can save tax on them. Strategy 19, intellectual property licensing. Created courses, systems, or processes before setting up the company, license them back to your business. The company pays the royalties, gets tax deductions, and you receive income that might be taxed more favorably. Strategy 20, salary sacrifice schemes. Give up your salary in exchange for benefits like a pension contribution, cycle schemes, or company cars. Because your salary is lower, you pay less income tax and national insurance, and the company pays less employers' national insurance too. £3,600 annual pension sacrifice could save you £1,000 in combined taxes. Strategy 21, company car benefits. With electric vehicles, benefit in kind rates are incredibly low. So a £40,000 Tesla might only create a £1,000 taxable benefit. Compare that to buying it personally after paying tax on extracted profits. Strategy 22, R&D Tax Credits. If your business is involved in innovation, new software, products, or processes, you could claim an additional 86% deduction on qualifying costs. So if you spend £100,000 on R&D, you can claim £186,000 total relief. At 25% corporation tax, that's potentially £46,500 in tax savings. Even failed projects can qualify. Strategy 23, share buybacks. So instead of taking dividends, your company buys back your shares. If it's done correctly, this creates capital gains and not dividend income, and you might pay 10% tax instead of 33.75% on a high rate dividend rate. You need HMRC clearance, but for larger extractions, this saving is massive. Strategy 24, capital reductions. If your company has accumulated profits, but low share capital, reduces the capital and return excess to the shareholders. This gets capital gains treatment instead of dividend rates. It requires a special resolution or even a court approval, but the tax savings can be enormous. Strategy 25, business asset disposal relief. So if you're planning to sell, the first £1 million of gains get taxed at just 10% if you qualify. That's potentially a £100,000 tax saving compared to a higher rate dividend tax. You need 5% ownership, you need to be a director, and you need 2 years of ownership. And this is really good if you're planning on selling anyway. Strategy 26, alphabet shares. Create different share classes with different dividend rights, pay varying dividends to different people at optimal times. Your spouse gets more when they're in lower tax brackets, and you take more where it's advantageous to do so. Strategy 27, employee ownership trust. So sell your company to an employee ownership trust and pay zero capital gains on the sale. Strategy 28, group holding company structures. So set up a holding company to own your trading business plus separate investment vehicles. Distribute retained earnings up to the holding company, then down to the investment subsidiaries for better capital allocation without incurring any personal taxes. Strategy 29, VCTs and EIS investments. Invest in venture capital trusts or enterprise investment schemes for significant tax relief. VCTs give annual tax credits, EIS gives upfront relief. Higher risk but substantial tax benefits. Strategy 30, the patent box relief. If you own patents or profit from patented products, get taxed at just 10% corporation tax instead of 25%. That's a 60% reduction on qualifying income. Strategy 31, share incentive plans. Give employees shares through SIPs up to $3,600 annually tax-free. Great for retention, and you get corporation tax relief. And it works for directors too in the right circumstances. Strategy 32, tax-free termination payments. When closing your company or stepping down, you can make termination payments up to £30,000 completely tax-free. And that's a nice goodbye present from the company to you. Strategy 33, business relief for inheritance tax. Trading company shares qualify for 100% inheritance tax relief after 2 years ownership. Your heirs could inherit your business worth millions with zero inheritance tax. Strategy 34, relocation expenses. Moving house for business reasons? Your company can pay up to £8,000 of moving costs, tax-free, legal fees, removal costs, even some stamp duty. Strategy 35, timing your extractions. The most overlooked strategy is timing dividends across tax years. Use the director's loan to access cash, then formally declare dividends when tax efficient. Know you'll earn less next year. Defer dividends to take advantage of the lower rates, and this can save you thousands. Right, let me show you how this works in practice with real numbers. This is an example of a comprehensive approach. So you've got the optimal salary and dividend that saves $50,270. You've got your pension contributions, $40,000, mileage allowance, $3,600, home office rent, £4,000, various tax-free benefits, $2,500, interest on director's loan, £1,000, and your personal tax is around $3,200. That's an effective rate of 3%. Before you implement these, there's some crucial warnings. Everything must be genuine and commercial. HMRC will challenge artificial arrangements. That mileage must be real business travel. Those family wages must be for actual work at market rates. Some strategies will need professional setup. Don't attempt complex structures without proper advice. The savings justified with professional fees. Your circumstances matter hugely as well. Student loans, child benefit restrictions, mortgage applications, they all affect which strategy is going to work best. And remember, this is about paying what you legally owe, not avoiding legitimate obligations. But there's no requirement to pay more than necessary. And HMRC will keep finding new ways to grab your money. The Employees' National Insurance hike won't be the last attack on business owners. But now you have 35 legal weapons to fight back. Even implementing just a handful could save you thousands a year. And don't forget that comprehensive checklist link below. It's got every strategy we've covered, plus updates when the rules change. Business owners are not the only ones in the government's crosshairs. They're coming after people who own crypto. So make sure to watch that video and find out how to keep HMRC off your back.